You might come across images of taxi drivers sitting and waiting hopelessly for hours on end, or upscale restaurants that have cut prices by as much as 50%, yet still have rows of tables sitting silent with no customers in sight. Meanwhile, as the crowd panics watching million-dollar apartments lose value, there seems to be a group uncorking $20,000 bottles of champagne to celebrate, the ultra-wealthy. Why can the collapse of a paradise be good news for the true sharks of the financial system? It seems that, for them, this is not a disaster, but a necessary purge, an opportunity to take profits at the peak and prepare for a new wave of acquisitions on the ruins of those who came late. Could it be that the collapse we are witnessing is actually a carefully calculated plan by the richest players? Stay until the end to find out. Dubai International Airport. A name long associated with seamless global connectivity, and Emirates' luxurious first-class cabins, seems to have become the center of a logistical nightmare. An incident involving unmanned aerial devices near the fuel storage area has pushed this massive operational system into a state of paralysis. And it didn't stop there. In Fujairah, the energy choke point at the entrance of the Strait of Hormuz stability itself now seems like a luxury concept. As fuel supply operations came under threat, confidence in the global commodities market appeared to collapse along with it. Perhaps putting all your eggs into a highly centralized infrastructure basket was never a smart strategy. Just imagine this. Low-cost aerial devices, perhaps priced no higher than a mid-range watch, are forcing billion-dollar defense systems to activate. Expensive interceptor missiles, likely funded by massive defense contracts from corporations like Lockheed Martin or Raytheon, seem to be struggling to chase down these technological mosquitoes worth only tens of thousands of dollars. You know, in Dubai, safety used to be considered a given, like the chilled towel on a Delta or United flight. But in that March, everything seemed to change. Peace of mind suddenly became a luxury commodity that only the ultra-rich could afford. The emergency private jet market exploded, with prices that might raise eyebrows even among Wall Street executives. A ticket to escape the disruption cost as much as a suburban villa in Georgia or a high-end condo in Florida. It seems the elite were rushing to flee this paradise, leaving behind dazzling physical structures that now appear to lack a truly solid foundation. Capital flows are more sensitive than anything else in the world. The concept of a safe haven premium, the reason many were willing to pay sky-high prices for Dubai real estate, seems to have evaporated along with the smoke rising at DXB. Major financial institutions, likely familiar names like Goldman Sachs or Morgan Stanley, appear to be quietly executing contingency plans. This shift no longer seems hypothetical. Capital is finding its way toward places with genuine transparency and stability, perhaps financial hubs in Southeast Asia, where the rules of the game are clearer than in an oasis filled with geopolitical uncertainties. It appears that the era of unconditional promises of a desert paradise is entering a painful descent. Imagine you're driving a luxury Cadillac on the highway, and suddenly, an invisible hand pulls the key out while the car is at top speed. That was likely exactly how investors in Dubai felt on March 2 and 3, 202648 hours of frozen activity after a comprehensive pull-the-plug order on the UAE capital markets. Perhaps no one expected that symbols of financial freedom like Nasdaq Dubai could be abruptly switched off by administrative order. Regulators seem to have made a dramatic decision to suspend all trading activities on ADX and DFM. The official reason sounded polished enough: to protect investor interests. It seems that before the curtain fell, a massive wave of sell-offs had already wiped out billions of dollars in market capitalization. When the shutdown order was issued, investors appeared to find themselves locked in a burning room with the emergency exits tightly sealed. All assets, whether stocks or digital portfolios, suddenly seemed to be nothing more than lifeless characters on a computer screen, unable to be converted into cash. Fund managers at major institutions like JP Morgan or Goldman Sachs likely have a term for this situation: preventing a stampede. It seems authorities believed that shutting down the market would stop the panic. But reality appears to be the exact opposite. When you can't withdraw your money, your defensive instincts surge stronger than ever. Could it be that Dubai is no longer truly a free market? Have property rights and the freedom to trade been set aside by a single administrative order? If so, this seems to have triggered a quiet reverse stampede. as smart money began looking for ways to exit domestic banks at the first available opportunity. We often look at growth figures to evaluate an economy. The UAE seemed proud of its 3.1% GDP growth in 2024. But do you see the irony here? GDP appears to be just a number of the past, a mirror reflecting what has already happened. Meanwhile, liquidity is the true lifeblood of the future. When financial circulation is cut off, the economic body seems to fall into a state of clinical death, despite theoretical reports still looking impressive. Confidence in the banking system also appears to be eroding. Stock collateralized loans likely faced painful waves of margin calls as soon as markets reopened. It seems that an economy built on expectations and debt always carries a highly vulnerable Achilles heel. Dubai was once compared to the Switzerland of the Middle East, a place where money seemed absolutely secure. But the recent shutdown has completely shattered that image. What do you think? If we missed anything, feel free to comment below and let us know. 131,234. That is likely the number of new housing units expected to flood the Dubai market in 2026 alone. To put it into perspective, this figure seems several times higher than any previous golden era. But here lies a deeply ironic paradox. While cranes continue to operate tirelessly, actual demand appears to be in free fall. It seems that 81% of this supply is concentrated in luxury apartment towers, a segment the ultra-wealthy are beginning to grow tired of. Building a glittering tower to showcase on Instagram is easy, but finding enough buyers willing to spend millions of dollars to fill them amid geopolitical instability appears to be an entirely different story. Major developers may have been overly confident in pushing projects forward to capitalize on previous capital inflows. The result seems to be a market now poisoned by its own excess generosity. As new supply floods in while liquidity is constrained, the value of existing units appears to be dragged down to concerning levels. But perhaps the most telling figure is 59%. That is the actual completion rate of projects during this period, a huge gap compared to the glossy promises. You can seemingly spot unfinished steel skeletons standing alone in the desert potential concrete graveyards as foreign capital begins to dry up. What looks glamorous on social media may simply be a facade masking stagnation at construction sites. S&P Global appears to have run out of patience, issuing increasingly bleak analytical reports. It seems the off-plan model once Dubai's golden goose is approaching a breaking point. As trust erodes, individual investors appear to face the risk of losing the money they have paid in installments. The hot capital flow from Russia, once considered a lifeline with over $6 billion pouring in, now seems to be quietly reversing course. Meanwhile, Asian billionaires, who are typically highly sensitive to risk, also appear to be prioritizing safety in markets with more robust legal frameworks. Perhaps they are realizing that a beachfront apartment in Dubai is no longer the ideal safe haven, especially as new transparency regulations begin to be strictly enforced. Do you remember the old days when the name Dubai was synonymous with a blank check of financial freedom? A place where you could bring your money, build an empire, and never have to hear the word tax? Perhaps those golden days now seem to be fading into the past. The title of a tax-free paradise that Dubai had maintained for decades has likely been officially terminated. With the introduction of a 9% corporate income tax, authorities seem to be sending a message that the free party is over. Why would they do this now? Perhaps the pressure from massive debt exceeding 112 billion AED has become too much for the budget to bear. Especially with floating rate debt hanging like a sword of Damocles, authorities seem to have no choice but to knock on corporate wallets. But don't let the 9% figure fool you. It seems that hidden fees from administrative charges to infrastructure costs are sprouting up like mushrooms after the rain. U.S. companies based here, perhaps branches of Ford or major consulting offices, appear to be realizing that the real cost of maintaining glamour in the desert is now just as expensive as setting up in Manhattan, yet lacking the stability they have always expected. In finance, discretion is sometimes more valuable than gold. But to gain global recognition and exit the FATF gray list in February 2024, the UAE seems to have sold its soul: absolute privacy. The domestic banking system, once flexible and easygoing, now seems stricter than IRS auditors. Their increasing scrutiny over the origin of assets appears to offend the business philosophy of global billionaires. Perhaps for someone who values privacy, being questioned like a criminal just to deposit money in a bank is simply unacceptable. As a result, a quiet wave of capital flight seems to be underway, as the ultra-wealthy begin shifting assets to places where they can sleep peacefully without constant scrutiny. Absolute financial freedom was once something only Dubai could offer. But as taxes appear and transparency becomes mandatory, Dubai seems to have turned itself into a normal market. US. Investors will likely prefer a place with clear but stable taxation like Singapore, over a place that once promised no taxes, but changes the rules mid-game. This forced transparency appears to have cut off the lifeblood of speculative capital, the very force that had inflated Dubai's real estate bubble for so long. Perhaps when ease disappears, what remains is a market full of risk and lacking predictability. Becoming a normal rule of law market seems to be making Dubai less attractive than ever in the eyes of the elite. Transparency may be a bitter medicine Dubai is forced to take to integrate globally, but it also appears to be paralyzing the very growth model it spent years building. Have you ever wondered why in every crisis, there is always a group that not only remains unharmed but seems to grow even richer? While the masses struggle with bills and evaporating investments, the ultra-wealthy appear to have packed their bags and left long before. In Dubai, this story seems to be repeating itself with a nearly perfect script for the top 1%. Money has instincts sharper than any military radar. Perhaps as early as late 2024, when tax policy changes and geopolitical clouds began to gather, family offices could already smell the smoke. The smartest players never wait for gunfire to start running. They seem to have quietly moved their assets years in advance. While you and I might still be watching ads for luxury beachfront apartments, large capital flows appear to have already found their way to Singapore, where legal stability seems stronger than skyscrapers built on sand. Or even to Riyadh, where Saudi Arabia is using incentives from Vision 2030 to drain vitality from its neighbor. It seems that for these migratory birds, Dubai has run out of exploitable value. They appear to have liquidated their high-end real estate portfolios as early as late 2025, right when prices seemed to be at their historical peak. They managed to turn concrete into cash before the liquidity trap of March 2026 snapped shut. While retail investors were trapped in a frozen market, the ultra-wealthy were likely sipping bourbon in a luxury apartment on the Upper East Side or an estate in Texas, celebrating their escape from the stampede effect. They seem to have prepared second passports and offshore accounts in advance to protect every dollar of profit. The difference between a loser and a winner may simply be who sees the exit before the crowd notices the smoke. But don't assume that once they leave, they will never return. The ultra-wealthy are not only celebrating their early exit, they are also celebrating because Dubai's collapse appears to be creating a necessary market purge. Large hedge funds seem to be watching from a distance with massive cash reserves, waiting for the moment when everything falls to bargain prices. It seems they are preparing to acquire strategic assets from key logistics infrastructure to prime land on Palm Jumeirah at prices that may be only a fraction of what they once were. For these sharks, the decline of a city is merely a normal business cycle. They celebrate because they may soon own symbols of extravagance at liquidation-level prices. 112.4 billion AED. At first glance, 21% of GDP might not seem like a house on fire, especially when compared to the debt-to-GDP ratios we see back home in the States. However, the real trap, Dongyu, perhaps lies in the fine print of its structure. You see, the vast majority of this debt is likely tied to floating interest rates. In an era where central banks are aggressively tightening monetary policy to wrestle inflation to the ground, the cost of servicing these obligations appears to be transforming into a massive financial black hole, one that quietly swallows every bit of economic effort before it can even reach the street level. Those massive, state-linked conglomerates that were once the glittering pride of the region now appear to be staring down a very grim reality. They face a mountain of maturing obligations at a time when the abundant, hot capital they used to roll over their debt has seemingly vanished. Some said that the gray-suited analysts at rating agencies like Moody's and Fitch are no longer blinded by the desert sun. They are looking at these monuments of extravagance with deep-seated skepticism. This, of course, makes the cost of new borrowing feel as punishingly expensive as maintaining a classic Mustang on a shoestring budget. As traditional revenue streams from oil and luxury tourism seem to be drying up following recent geopolitical shocks, the authorities may find themselves backed into a very tight corner. There, Dong knew it seems to be a strategy quietly clicking into place, a tactical suffocating of those who couldn't get out in time. If Dubai once lured you with the siren song of being a tax-free paradise, it now appears to be pivoting toward extracting every possible cent through a dizzying maze of public service fees and residency surcharges. The professional middle class and the smaller, trapped investors appear to be becoming the unwilling, sacrificial lambs of this new era. Those who don't have the luxury of calling up a NetJets pilot to spirit them away on a private wing seem to be left bearing the full, crushing weight of sustaining an administrative apparatus that has grown increasingly hungry for cash. Instead of coming here to build a nest egg with the speed of a Wall Street shark, foreign experts now seem to find themselves on a treadmill. They appear to be spending the lion's share of their hard-earned income just to keep up with the skyrocketing cost of living and a flurry of newly minted fees that look suspiciously like taxes in all but name. Maybe those who remain today are simply paying the tab for the champagne-soaked extravagance of those who came before them. The iconic skyline and those palm-shaped islands seem to have been built with the cheap money of the past, but the maintenance bills and the interest payments, those belong squarely to the present. You may say the allure of this entire economic model is evaporating faster than a puddle in the midday sun, making way for more transparent markets with realistic operating costs. One can't help but wonder, were the foundations of this paradise ever truly solid, or were we all just caught up in a very expensive mirage? Do you feel that this system favors the elite too much? Let us know your thoughts below. Do you notice the striking contrast between the dramatic volatility of the desert and the almost boring stability of Singapore? For the seasoned investor, the kind of man who values the ironclad predictability of the U.S. common law system, Singapore is increasingly looking like the only adult in the room. In the Lion City, the rules of the game don't appear to vanish overnight, simply because a local official had a change of heart or a sudden budget crisis. Singapore seems to be doubling down on its reputation as the Switzerland of Asia, and it's doing so with a refreshing lack of drama. It simply does exactly what it promises. While those abrupt market freezes in the UAE are busy eroding decades of carefully curated trust, Singapore remains an anchor of financial security. We are seeing a quiet but significant exodus. Elites from the upper echelons of Silicon Valley titans like Google and Meta appear to be trading their Dubai penthouses for a more grounded existence in Southeast Asia. They seem to be searching for a deeper, more sustainable environment for their families, a place where education and infrastructure aren't just flashy marketing slogans. It appears that while you can certainly buy glamour with a large enough check, true stability is a vintage that must be aged with time and discipline. Meanwhile, back in Dubai, the emergency exits are beginning to jam. If you follow the whispers in the halls of the Dubai International Financial Center, DIFC, you'll know the reports are becoming impossible to ignore. Hedge funds and family offices are quietly filing their paperwork to leave. You and I both know that smart money is as sensitive as a great white. Once it senses the lifeblood of liquidity is drying up, it doesn't hang around hoping for a miracle. This capital isn't just seeking refuge in Singapore's banks. It appears to be flowing into the beating hearts of emerging markets like Vietnam and Indonesia. In these corners of the world, value is being forged in factories and driven by the genuine consumption of hundreds of millions of people. It's a far cry from the virtual wealth created by shuffling deeds to half-finished luxury condos. The departure of these asset managers, Dongnu, perhaps marks the final curtain call for the illusion of a global financial hub on the Persian Gulf. But the most predatory threat isn't coming from the Far East, it's coming from right next door. Riyadh appears to be orchestrating a remarkably ruthless campaign to systematically drain the vitality of its neighbor. Saudi Arabia's Vision 2030 is no longer just a PowerPoint presentation. It seems to be a mandate that is turning Dubai into an outdated satellite office that the big players are no longer interested in leasing. Saudi Arabia holds the one trump card that Dubai could never manufacture, a massive, young domestic market with actual purchasing power. With new mandates requiring multinational corporations to move their regional headquarters to Riyadh if they want to keep their government contracts, those gleaming towers in Business Bay are starting to look like very expensive glass bird cages. In this war of attrition, it appears the side with the deeper pockets and the tangible resources is gaining a decisive, perhaps permanent, upper hand. It seems the desert's golden child is finally learning that in the real world, the house doesn't always win. In the end, when the bright neon lights go out and the noise of advertising campaigns fades, only real value and a solid legal foundation remain. Glamour may attract attention for a moment, but transparency and predictability are what keep capital in place over the long term. We think now is the right time to ask, do you truly own your assets, or are you merely borrowing them under the temporary permission of a government? Let us hear your story in the comments below.